Good evening, everyone. Today is a good day, 12th December 2020, 7:52 p.m. Malaysian time. So today is a very good catch up with all of you since my last video posting about 2-3 weeks ago. Today's topic is a bit interesting. From my it's interesting because we will try to find out, what I would like to do is to share some ideas on how to identify when a company, a listed company, is potentially undervalued to be acquired or is attractive to an external or internal acquirers to be acquired or taken private. Of course, acquirer, there is actually the internal and external. Internal would be your major shareholders that currently hold a big shareholding block in the company, of which they feel the company is currently is undervalued, hence they would like to take it private. Okay, here comes the standard disclaimer. Just want to highlight again that this short presentation is not an investment or trading advice or endorsement of any sort of investment recommendation. Strictly for illustrative and also entertainment purposes. If in doubt, I think I'd like to stress this many times, please consult your licensed planner or advisor. When is it conducive to acquire? Of course, the direct answer is when it is undervalued. The question for a company to be undervalued can be objective or it can be subjective. However, what is undervalued party may not be undervalued to another party. The value to an acquirer is very much specific to an acquirer's perspective. So, for example, a company that is trading at 40 times PE, from an investor A, the investor A may say this is very expensive because the industry peers are trading at, say, 20 to 25 times PE. But from investor B, for example, investor B say that I would like to acquire this particular company at 40 times, even willing to up the valuation to 50 times PE, including premium to the market price, because there are synergies that I can integrate that to my existing businesses. So, in a nutshell, what is undervalue or overvalue very much depends on the acquirer's perspective. Now, the thing is, to me, I feel there could be certain areas where we can roughly carve out what is undervalued, like very broad objective assessment. I've listed down some possible criteria to assess whether the listed company is actually overvalued or undervalued. My first point is the valuation multiples tend to be low. It could be lower compared to the industry multiples, meaning to say, you are trading at a lower multiple than your peers. And one area is that particular industry and the companies, there are still some level of growth. May not be high growth, but there's still a level of growth. When it comes to undervalue, you don't want to invest in companies that are in the sunset industry. Those are like the gone case. So hence we look at that the criteria. One of the criteria is there's some presumption on positive growth in the industry and as well as the company. Of course, the other important part is that it still generates sustainable cash flows year after year. Now, coming to more quantitative criteria, let's look at possibly a revenue year-to-year growth of at least 1%, net income of at least positive 1% growth, return on equity. Now, return on equity and the other next point, price to book, it kinds of links up to each other. I feel that if return on equity that is more than 10%, if it compared to your required cost of equity, if it's higher, it tends to mean that you should theoretically trade above the book, i.e., your price to book should be at least 1 time. So hence, I put a return on equity on 10%, which is, well, depending on how volatile or the industry and how risky is the industry, but 10% is quite reasonable. And that links to the next key point, that is price to book, that's 1 time. So if your ROE more than 10% and your price to book less than 1 time, that potentially means you could be undervalued. Potentially. Of course, gearing level is important. From an acquired perspective, if the company has very high gearing, that may not be undervalued because the share of profits of future cash flow may be rerouted back to the lenders as the main primary funding capital provider. The last point, it's more like trying to say that this company does generate sufficient liquidity, and the current ratio at least 1 time. And a company that has current ratio that's less than 1 time tends to raise a few alarms. You wouldn't want to acquire it. Okay, in this slide, I'll just briefly go through the criteria that we mentioned on the previous slide. So, using a filter that is available nowadays in a lot of broker house, they do provide filtering screening system. So looking at an ROE average of at least 10%, as I mentioned earlier, a net income growth of at least 1%, a total debt to equity gearing level of less than 30%, price to book of not more than 1 time, current ratio of at least 1 time, revenue growth rate of at least 1%. Now, we apply this criteria to the ASEAN countries, namely Malaysia, Indonesia, Thailand, and Singapore. So from that criteria, plug it into the screening system, draw out about 18 stocks. Now again, I want to mention the disclaimer, reiterate disclaimer. This is strictly for illustrative purpose only. It's not for investment advice or trading advice or recommendation. We just want to see what companies that are potentially undervalued based on the assumed criteria. Now, the assumed criteria, it's not universal, like I said from day one. It's a very simplistic assumptions. We just base on ROE more than 10%, price to book less than 1, and all those. These are really simplistic assumptions. Okay, if you see Malaysia, there are about 5 companies there from various industries, industrial goods, collective investments, energy, software, and IT services. Some of the net income growth rate of like more than 100%, I wouldn't really I wouldn't really give much weightage on that. I think something that, you know, when you do screening, you always need to look closer behind the numbers, whether there's any non-recurring items. And what is more important is actually to determine what is the sustainable numbers or the more unimpacted numbers. Okay. Um, I think if you see APRP current ratio of more than 68 times, that requires certain investigation or re-examination of the numbers. Mm. Okay, if you look at Jakarta, also industrial goods and chemical, um, some of the ratio looks all right. Then if you move on to Singapore Stock Exchange, certain numbers looks all right. Of course, the other one on Thailand, the broker group, 16,000 times net income growth rate. Okay, but I think the message is there. I think certain of these numbers need to be further re-examined. But you see, this is a very simple. What we have done is a very simple criteria based on very simplistic assumptions. We try to identify companies that may be potentially undervalued, potentially, and would we see these companies being acquired by external parties or even taken private by their major shareholders? It's something to look at, you know. It's a very, at least an approach, systematic approach in identifying all these companies. 18 companies, not many in the stocks, but yeah, something to look at in long run. Okay, I've reached the last slide that I would like to discuss this evening. Um, I think moving forward, it's important for us to really understand why an acquirer wants to acquire a company or take a company private. There are a lot of things that you know are not that apparent on the surface. We need to dig deeper to understand what is the real intention of the intention or even the real synergies from acquiring the stake in the company. Thank you so much. Hope to see you guys soon. Bye.